if I'm looking for a short, and I'd say that I very likely am, I'm expecting, first of all, my main downsloping target for the short, and then the upsloping target, which is going to be top of this channel. Now this is where it gets a little dicey here. Do you use that low of the 5-minute bar, or do you use the lowest closing price? If I use the lowest closing price, I'd say we're sitting on top of that one now. Yeah, that's no good. So I could use the lowest price there, but that's not it. This is the price. That high or low. Although it is just the low of the next 5-minute candle, that's the one I'm looking for. So I want to see it come up into right there in the next 10 or 15 minutes. I'm just seeing if we got anything else lining up here. Yeah, we were thinking almost go short there into the close. Glad I didn't. Well, a buddy of mine was thinking about it. That's the one. That's the one that's lining up. So we want to see it pop right into there, which I'm pretty sure we'll see happen before I'm done. And look at the volume that's picking up. That's to the downside, huh? Majority. Although it is for... No, I can't say that. The majority is to the upside, in fact. All right, let me explain what that number means. So if I turn on, I want to use this time to kind of bring you up to speed without the benefit of having, multiple PDF guides for you to look at and sort through at the same time. That would be lovely, but that's not the case today. Now, it will be the case by the end of the week. Now, show me the close. You can barely see it. Let me make this just a little bit lighter and then just finally fix their colors. Okay, that's the close here, huh? So this 266, that means that from the reopen at 5 p.m. today, from the reopen, it is 2.6 times more volume trading than we would usually see during this time of day. And that's incredibly significant. Anything over 140 is significant. So what would that mean? That would mean that you could safely expect, with a degree of 0.55 probability, maybe a bit more in this case, that you're going to have roughly 2 times more volatile movement in the markets than you had over the past 6 days on average, 6 trading days on average. I think it's 6. It might be 7. Just double checking here. 6, yeah. And that could be to the upside because the majority of this volume is to the upside, although you see it dropping off here. So it's kind of fizzling out. I want to see it pop right into this area. And then we'll have our retracement. Now I'm going to be a nervous wreck trying to short that because I have quite a bit of volume against me. Now it's not actual volume, it's not the true number of traded contracts that are against me, but who do you think is the majority makeup of this overnight volume? It's not people like me and you. It's people, in my estimation, and according to some people that portray themselves as having this insider information, uh, it is those private individuals who work at firms and funds that make up the big institutions, because they have a little, uh, they know already to some extent what it is that they are trying to achieve this coming week. And that may be, you know, tens of thousands of orders in buying certain S&P stocks or whatever. And this is their way of trading that without getting in trouble, probably through secondary accounts in, grandma's name or some other whatever name, who knows. But that's just an estimated guess, I could say, based on other people's intel, at best. Just a theory. It's not even something I can hypothesize about. Let's see. I got to do this on the next size chart up. All right. So what I want to get into is the differences between the row 1 and the row 2. Okay. Again, this is all based on trying to adapt workspaces that are seemingly incredibly complex just by the sheer number of charts that they have, when in fact they're built as such to accommodate two styles of trading, which thereby does make it a bit more complex, doesn't it? So wouldn't it be nice if you were a day trader and day trader only and didn't have to worry about all of these higher time frames that Daniel forces you to use? So next year, that's what we're going to be focusing on, building out specific, very, very dialed in workspaces, indicator strategies for very particular styles of trading. And we're going to get it pretty well dialed in as best as humanly possible. And those are the things that I really, really love doing. And I was about to say excel at, but those are the things that I like doing best, and therefore the work that comes out of that tends to be better than otherwise. So, in my estimation. So, I was watching Bo looking at this and thinking, that last set of waves up is awfully ending diagonal-ish looking. And just making sure we got enough time to go over this. Yeah, let's say we do. So, I'm looking at that. I was thinking Bo had caught this high. He had it marked up. It was just pretty fast into it and down from it. Pretty sure Rerd caught it in there. What Bo caught was this high here down. I think he got, 3.5 to 1 or something. I didn't actually write it all the way down, but when I was looking at this high, I was thinking, it could be that wave 1 high, or sorry, wave 1 low is this low, and that this is a ABC. Maybe you get a triangle X out of it, or that's just the X. And then you've got an ABC for 1, ABC down for 2, ABC up for 3, 4, 5 ending diagonal, because just look at the way it kind of, I was going to say coalesced, but I mean, it gave that range bound wedgish looking pattern. And normally I'd be waiting for the same exact thing that he was, a break of that high. But when the average range goes down, and that's another thing that's difficult about this, it is fresh into the Euro session, so you wouldn't expect that average range would pick up. But right at about 10 after 8, 20 minutes before the open, you get that really good looking volume divergence on the 5-minute. Sorry, the 10-minute. You had it on the 5-minute as well, but right there. You've got your really beautiful volume spike here. You go back down, sign of weakness, climb back up, and you tick it out and get that beautiful fat churn bar that's actually higher relative volume than the preceding 6 or 7 bars, 8 bars. And perfect volume divergence signal. It's almost triple divergence, not quite, but I think on the 5-minute it is. And then it falls off that cliff. I'm not usually one to trade trend line breaks, but after an ending diagonal that you've missed, that's really the only opportunity that you have, because they tend to move really, really quickly. I mean, the statistic goes wherever the ending diagonal began, which you would say is right there, you tend to retrace all of it in less than half the time it takes to make it. So from here to that high, it took what? 71 bars, so 11 hours and 50 minutes. Let's just say 71 bars. And you broke it in how many? You didn't break it until that one in 11 bars. That's much more, or sorry, that's much less than half. So that is, oof. So yeah, you would be expecting a very, very fast move. And in this case, let's say you started with the trend line from where the ending diagonal began. You just barely missed that kiss goodbye right there, such that if you did sell the break of it in the close of that 10-minute bar, you would have waited for the retracement back up and kiss goodbye. But what is the second best option for that? I don't know, Daniel. It's from right here to right there, and then up, kiss goodbye from that line. So I wasn't making fun of you, I was making fun of myself. In fact, it's clearly that, but it's not so obvious in real time. I would have drawn this one in real time, and I would have been a little bit leery of that had it not stopped at that 100% warning line there. And then where did it pull back to? I guarantee you that's got to be where majority of the volume of that swing resides. I would expect. Oh yeah, look at that. Isn't that just spatial? It does look good, doesn't it? So now, if that's a 10-minute chart, I would expect that this would be a setup on the 2-minute chart. Let's look at that. Are we getting closer? Not quite, but when it gets there, I want it to get there all within one 5-minute bar, and then hopefully followed by a churn bar. So I need to get my alert out. And actually, I'm going to put my alert right here. There we go. So now if I hit that, if the ES hits that, I'll get an alert giving me enough time to then pull it up and figure out whether or not I want to actually take it. And the only problem with this is, where do you start the fib from? Do you start it from right here or that higher low? I'm going to start it from the higher low. Well, naturally it's 100%, 100% because it's the top of the channel. And it's right where the top of the channel is met with the median line. Pretty close anyway, more or less. Right there. I'm just going to clean this up a little bit before I move on. Oh, look at that. Man, just something else, isn't it? Watch it just go right through it and make me look all crazy. Oh, it's moving, it's moving. Well, yeah. Better do it if you're gonna do it. I want to do it in Blackbird right now, but, well, it's not happening. Okay, so you see the signal. This is the operative time frame, right? OTF is operative time frame. There it is. That's exactly what I said I wanted to see. Extremely high density. Now I want to see a churn bar following it immediately. Dang it. Oh, it is already a 2-bar pattern on the 2-minute. Okay. Oof, look at that. I should be getting short one right now. All right, so it's even showing up on the 2-minute exceptionally. And that's what I want to get into. How can it show up on the 2-minute, the 5-minute, and the 10-minute? How is that possible? How is that allowed? I should be short right now, but I'm not doing it. Because I'm going to teach about it instead. So there is our signal in the market geometry. Oof, as we had right there. So this is chart number 1. Well, I'd say chart number 1 is the operative time frame. What is it? Well, it's actually 2-minute, 5-minute, and 10-minute, which is a rarity. Okay, enough of this. What's going on? I mean, that's about as good as it gets right there. Why would you not take it? Why would you not take it? For one thing, that is a very particular pattern here. It's not, I'd say that's more of a V bottom. And for me, a V bottom, it doesn't have to go straight back up. It just has to do a V as such. And then it can come back, and that's the low that I'm always looking for after a V bottom. Preferably from that lower median line to the tick. Interesting. It's funny stuff, this market geometry, I tell you. All right, so why might I not take it? Because of this, the fact that on the higher time frames, you have what looks like this on the hourly, namely right here. Big volume divergence. It's a new contract. A lot of people are thinking, you know, this move is exceptional. It's, you know, all fake money. It's true. And it's got to come down. It's got to come way down. Well, in my estimation, all it needed to do was break that low. Okay. Didn't have to do any more than that. Really, I started off saying that low because I thought that was a triangle, but it wasn't this low. So I wanted to see that low be broken. If it is going to come lower, then I want to see it come back into these lows. And then we would have a proper, it could still be a fourth wave, but at that point I'd be thinking wave 2 of 5 for a really big extended fifth wave up. And see how that's 261.8 at the high. That's the main reason I'm thinking 1, 2, 3, 4, and then 5. So do I really want to short into that? Well, the fact is, normally when it hits the 161.8 as the end of wave 3, not necessarily 261.8, you'll retrace back to the 100% as long as that 100% of wave 1 from the end of wave 2, this is an extension, does not go inside of the wave 1, which it does not. However, that is a 61.8 retracement of wave 3. Currently, we've made a 50% retracement of wave 3. And each time we get down in this price area, it V-bottoms right back up. Sorry, it creates the low, and then it pushes straight up out of it in a V-bottom each time. And I'm leery of this, thinking that it may just do the same because it's now also touched this high, right? And then we've slightly overthrown that low, that channel. So that is an acceptable throw over of a channel to still be valid. And this gets me every time when it's a big channel on a big chart, pulling back into that now kiss goodbye. That's also a reason for the short, but you're shorting back into all of this, momentum divergence, volume divergence. Momentum divergence is not nearly as important to me in this case because it's just ever so slight. That volume divergence is actually quite meaningful, especially with the size of that wick pushing up and out of that area on the ES. That perfect 50% retracement, top of that high. It's a pretty good spot for a major low. I mean, really. It's just a very awkward looking pattern, isn't it? It's quite awkward indeed. Let me just check something out real quick. Could that not be a running triangle high right here? Could that not be a... Yeah, it can, actually. C, D, E. That would not be my preferred count. But yeah, that's a valid count. And then what do you have? What do you have? If that's what the count is, what do you have? Hmm? What would this complete for wave 4? Hmm? ABC down for W. Triangle X wave, which is typical. Well, typical is, either straight line or totally sideways. And this is totally sideways. And then another ABC for the Y wave of wave 4. So if I had to label that as a completed fourth wave, that's how I would do it right there. That's quite lovely, in fact. Interesting stuff, huh? Not really, Dan. But if it is, my short is kaput already. I really wanted to get into that while I'm talking to you, but um, I don't want to. I'm not going to do it. I'm not going to do it. Look at that. What did I say on the 5 minute? Big climax, and then I want to see it followed by a churn bar. What does that give us? 2 bar pattern. Hmm. Didn't go as high as I wanted it to go, though. I mean, that's for all intents and purposes. That's pretty much a hit. Man, I'll tell you what. If it comes back and it hits right here, then I'll do it. But the whole goal of this exercise is to go over why it is you can get a signal on the row 1 and the row 2 from multiple charts. So that's the signal from the row 1. I don't guarantee it, but I'm pretty sure, yeah, there's the signal from the row 2. All right. You can forget about all of these historical signals. They would not look like that in real time. Why? Because this is a real-time system, and at any point intra-bar, those volume signals can change. They can change from being a big, beautiful churn bar, and then all of a sudden it just grows in range by just a few ticks, and then it's uh, a normal climax bar that's high density or something. Found it, didn't take it, showed it. Yep. You see the importance of using the high or low, though, huh? When you've got a wick like that. In fact, let's see. Maybe that one would have been better, actually. The real high or low. But the main area that we had here was what? It was this one. And did we hit that? We were within half a tick from it. So I'd say that's a hit. Now this is where it's going to make it or break it time right here. So that's the first spot at which it can fail. Then we'll call it a day. And there was your short trade. See? Amazing. Just amazing.